part 2 of our USDT futures perpetual swap video, where we're talking about risk management. We've done a video before on risk management. If you have not watched it, I'm putting a link to that video in the description of this video. It's great content. We talked about how to manage risk, how to calculate your position size so that your trade is within acceptable risk level. We talked about acceptable versus unacceptable risk. We talked about using stop loss. Now today we are going to focus on how to ensure that our risk management work. All right, we're going to talk about how to ensure that our risk management work. We're going to talk about isolated versus cross margin, things like high leverage, and some beginner mistakes to avoid when trading. All right, let's go. Now, risk management won't work in isolation. You need to understand that in order for your risk management to work, you should have a trading edge. Your trading edge is simply what gives you a greater probability. Your system or your idea or your strategy that gives you a greater probability of making profit in a trade or in a given set of trades. All right, then there's also the risk reward ratio. You need to take note of that, and then you need to also take note of your win rate. All right, your trading edge should be such that it gives you a greater win rate, and then you should have a risk reward ratio that is good, so that you get a greater probability of making profit in the long run. All right, let's take a look at let's do an example. All right, let's say for instance you have a trading edge that gives you an 80% win rate. All right, you have an 80% win rate. That means for every 10 trades that you take, you have a greater probability of winning 8. Now, if your risk reward ratio is 1:1 and your win rate is 80%, it means that let's say for a given set of trade, let's say you place 10 trades, it means that you're going to win 8 of those trades and you're going to lose only 2 of those trades. Now, remember your risk reward ratio is 1:1, right? Let's say your risk is $100 per trade. That means that in a given set of trades, like 10 trades, you're going to make $800 and you're going to lose $200. And then your profits, after you take your loss into consideration, will be $200. Your net profit will be $600, which is not so bad. All right, let's do another calculation. Let's say your risk reward ratio is 1:1, but you have a 30% win rate. I know that you definitely know you're going to be making loss at the end of the day, because you're going to be losing pardon me, you're going to be losing 7 trades out of every 10 trades you make, and you're going to be winning just 3. So you're making $300 and you're losing $700. That is not good business. That doesn't make business sense. All right, let's say, okay, your win rate is 30%, but your risk reward ratio is 1:9, meaning that every time you place a trade, you have a probability of making 9 units or losing 1 unit. All right, and let's say your risk is $100. It means that your win rate, after going through a series of 10 trades, you would lose 7 trades. All right, which is just $700. Right, but you will win three trades. Now, what is the worth of 3 trades for you? It will be 3 multiplied by 9, and 3 multiplied by 9, you can do the maths. 3 multiplied by 9. I have a calculator somewhere. That's 2,700. So you're losing $700, and you're making $2,700 within a given set of trades. Now, to me, that sounds like a win. All right, so in order for your risk management to work, you are using stop loss, you are trading with only 1 to 0.5% of your trades. You need to make sure that you have a good risk reward ratio, and you need to make sure that you have a good edge, and it all comes down to your edge. At the end of the day, your edge is your system or your strategy or whatever you're doing that is ensuring that whenever you enter the market, you have a greater probability of winning. You want to have a good risk reward ratio, and you want to have a good win rate. Right now, let's talk about isolated margin versus cross margin. Now, I've seen a lot of traders, they don't really understand this, especially those traders trading on Binance, for example, because we're trading USDC futures, for example, and I usually trade on Binance and OKX, and you see the nuances, the subtle differences between these exchanges when you trade. There are some advantages and disadvantages, pros and cons here and there. All right, but isolated margin to me is more beneficial than cross margin. All right, now we have already established that whenever you enter a trade, you need to establish your risk. All right, and you establish your risk, you put your stop loss, you have a mental picture of an amount you can lose in a trade, and you accept it wholeheartedly, right? And you're good to go. But sometimes, for whatever reason, maybe you forget to put a stop loss, and then the market starts trending against you. It could be really terrible, all right? And that is why I use isolated margin. With isolated margin, you get to manually impute the margin that you want to use in a trade. All right, let me give you an example. All right, see these two trades now. All right, this is Binance. All right, now I'm trading with some isolated margin in this trade, and you can see right now I don't have any stop loss in this trade. But in a way, I'm not really scared of losing all my entire portfolio. You know why? Because I'm using isolated margin. If I was using cross margin and I don't have a stop loss, it means that I'm exposing my entire account to risk. It's really stupid to do that, because this trade could just go south and then wipe out your entire account. Even if you have up to 100,000 in your account, it could all go down. All right, because the market can be trending for a long time. All right, but with isolated margin, I can only lose $213 in this trade, because that is the only amount that I permit for this trade. All right, so for me, it's like an extra layer of protection. It's like some sort of stop loss. All right, so I know that my liquidation point for this trade is 0.573 for XSP, and so once the trade gets to 0.5733, I get liquidated. But liquidation in this case is not so bad, because I already used my hand to manually impute the amount that I want to risk for this trade. All right, now if you're trading with isolated margin on Binance, you have to be very careful. All right, so most times when you enter a trade with isolated margin, your position size is just the amount that will be left in the margin. Right, let's say in this case now for XSP, let's go to XSP. I want this to be very practical for you, for beginners out there. Now let's say you want to trade 856.7 units of XSP, 856.7 units of XSP, and it's going to cost you just $14 to trade. Now when you enter that trade with isolated margin, that could be the only amount that will be left for you, that would be allotted to that trade. Now if I have just $14 on margin, now it's risky for me because the moment the trade starts going against me, I could get stopped out or I could get liquidated so easily, and my $14 will be gone. All right, so what I do is that I make sure that I add to my margin to give room for my stop loss position, or to give room for the trade to go against me, all right, to an extent. All right, so you need to take note of that, because I've coached a lot of people, and this is one mistake that newbies make. They would forget, to add some some more positions to their margin, and they get stopped out so quickly. All right, isolated margin to me is more beneficial than cross margin, because cross margin exposes your entire account to risk, while isolated margin you are more conscious, right? Your entire account is not exposed. You consciously impute the amount that you want to risk in a trade. All right, so that is one thing. All right, you would notice that the balance here is 1,000 260. So you can see that definitely this account is not following proper risk management, because if it was, I should not ever get, I should not be risking so much. I shouldn't be risking $238 or $213, right? But this is just for the sake of this tutorial. Now, next question, next slide, guys. Next slide. High leverage is low risk. True or false? The answer is that leverage doesn't really matter. All right, what matters is your risk. All right, and leverage is just a part of risk. All right, if you're using high leverage, it could mean high risk if your position size is constant, if your stop loss position is constant, right? Because your risk is a product of your position size, your leverage, and your stop loss position. If this is a mathematical formula, you can say risk is equal to position size multiplied by leverage multiplied by stop loss position. All right, so if you want to use a big position size, you can do that. To explain this, let's do a practical example. All right, now I want to ask a question: who is taking the greater risk? Trader A trades 10 bitcoins with 10x leverage, and trader B trades 0.01 bitcoin with 10x leverage. At the end of the day, if you calculate what trade, let's go back to the chart and do this practical. Now BTC, trader A wants to trade 10 bitcoins, and he wants to trade it with just 10x leverage. Right? He wants to trade 10 bitcoins, and he wants to trade it with 10x with 10x leverage. You would notice that the cost of this trade is $22,600. $22,600 plus. Now this is just the initial cost of the trade, right? This is not taking into consideration, the extra amount that you have to put in, to give your trade room to breathe. This is not taking into consideration of the stop loss position, the size of the stop loss position. This is just considering the position size and the leverage. Now let's calculate for trader B. Trader B wants to trade with 100 leverage, but he just wants to trade with 0.01, and he's trading with 100 leverage. And 100x leverage. So you can see that the cost of his trade is just 0.13 USDT. So what does that tell you? So a lot of people, they usually have this stereotype. They believe that if you're trading with high leverage, you're taking a greater risk. To me, that's not the entire picture. You need to consider the position size, and you need to consider the stop loss position. All right. If you could be trading with a high leverage and then you're taking a lesser risk than someone who's trading with a low leverage. All right. The question is, what is the position size? If you're trading one BTC with 100x leverage, you could be taking a lesser risk than someone who is trading with 10x leverage and trading 100 BTC. All right. And then, like I said, you need to also consider the position size. So leverage to me doesn't really matter. If you want to trade with high leverage and you want to take a low risk, you trade a very tiny position size. All right. And the fact that you're trading with with 2x leverage does not mean that you're taking a lower risk. All right. You need to also consider your position size. All right. So let's be guided. Now, generally, when you're trading with high leverage, you can make more profit with a little capital. But if you're trading with high leverage, you have an increased risk of losing capital. All right. And I need to state this. One difference between spot and futures trading is that futures trading is actually riskier than spot trading, because in futures you can actually lose money. Right. Let's take this example. Let's take this example of CRV. I like to use CRV because I love the way the market just went down to the clean downward trend. Now look at this. Imagine if you bought this coin at $4.62. All right. Whatever leverage, whatever position size you used, you will be in a huge loss right now. All right, you'll be in a huge loss because the market has gone down. Right now, if you made this trade on spot, in a way you can be a bag holder. You can hold your CRV for a very long time, and then perhaps it may happen, it may not happen. The market may go up, and you recover your losses. You recover every single time. And then if CRV goes to like $8, you could even make 100% of your money. Your money is still your CRV is still safe. It's just the value of the CRV that went down. But in futures trading, if you enter this position at 0.46, depending on your position size, depending on the balance of your account, by now you would have lost all your money. By now you would have lost so much. All right. Just imagine if you entered with 100x leverage and then you enter like 50 CRV. By now you'd have been liquidated. You would have lost your funds. All right. There's even a calculator where you can calculate your liquidation price. All right. Let's say you entered CRV at $4 and you entered with 1,000 units of CRV and your balance was $10,000. Let's calculate liquidation price. Something's wrong. Okay, let's use $800. So your liquidation price is 3.2. By the time the trade got here, you would have been liquidated. You would have lost your entire. In the example that I used, it was actually $800. I couldn't use up to $10,000. You entered the trade at $4. You entered with 1,000 units of CRV, and you had $800 account. You get liquidated by 3 points. By the time trade gets to 3.2, right? So, and being liquidated means that you actually lost that money. It's gone. There's no bag holder positions for you. There's no waiting for the coin to get up to move back to the point where you bought. Your money is gone forever. All right. So that is why if you're trading futures, you must use stop loss. It is not something that you can negotiate. It's not something that unless you want to be stupid and risk your entire account and lose all your money, use stop loss. All right. So the last thing we want to talk about today is some mistakes that beginners make. When you don't know what you're doing and you're making profit, it's a mistake, because it's only a matter of time. It's a time bomb. If you don't know what you're doing, you're just entering the market. There's this belief, and I resonate with it, that you don't really need any education. You don't really need any. You don't need to go to any trading school. You don't need to learn anything to make money from trading. You can just buy, and then if the market is in an uptrend, you have a greater probability of making money. All right, so just buy and then you make some money. Ooh, it's really interesting. You're happy, but you don't know what you're doing. You're just buying and you're just making money. It's a time bomb. It's a trap, right? Because it's only a matter of time before you start. Before the market conditions change, and then you're buying and you're losing money. The second mistake is that you're trading in a large position size and you're making profit. You can't go wrong by reducing your position size ever. I see so many traders when they make profit and they be like, oh no, I wish I traded with a large position size. I would have made $1,000 instead of $500. That's a big lie. All right, always trade small position size. Always trade small position size. It takes a lot of discipline, because once you start making money, you get into your head and you feel like you want to double your position size. You want to get greedy. Don't get greedy. Trade small position size. You are in this game for the long run, and you don't want to just take the fast money. It's not going to happen, right? What's going to happen is, the likely thing that's going to happen is that you don't know. Because the reason why you need to trade a small position size. Always trade constant position size. Always make sure you know your arrow, your acceptable risk, and trade within that level. You never know the trade that you will lose. Let's say you've been trading with $10 risk and you're making $20. And you've made 10 trades, $20. And you feel like no. The next trade is I'm definitely going to make it. And then so you double. You add several zeros. You're now trading with a risk of $1,000, and you're hoping to make a reward of $2,000. You don't know if that is the first time. The very first time you're increasing your risk, you don't know. Maybe that's the time that market conditions want to change, that your edge won't work, that you just lose. You don't know. So always trade small position size, right? Small position size. Whatever position size you have in your mind right now that you want to trade, think about it, picture it, and then do something. Do me a favor, reduce it by half. All right. You can't go wrong by reducing your position size. Trading without stop loss, we've talked about this time and time again. That is the single biggest mistake you can make as a trader. Go all in and make some profits. The market is going up, and everybody's making money, and you got this $2,000 account, and you just want to go all in. If you go all in and you make profit, it's also very bad, because it's just you've developed this bad habit, and you're definitely going to try to do it again, and perhaps this time with a greater capital. And if you go all in, you're risking your entire portfolio, and you could lose it, right? So never ever go all in. If you go all in and you lose, you get wrecked. If you go all in and you win, you also get wrecked in the future, because you're going to do it again. All right, and it's only a matter of time. All right. I hope this video was value for your time. I want to invite you to the EME Trading community, where you can network with top traders, get quality technical and fundamental analysis for your trades, and gain access to premium signals. Just click on the link bit.ly EME Trading Academy. I assure you, when you join this community, when you join this academy, your trading will improve, and you start making some really good money. Yeah, if you follow all the rules. Thank you very much for watching. Bye bye.